David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello everyone, I'm joined today by David Guttery, president of Keystone Financial Group here in Trussville, to continue last month's discussion about current market conditions and potential concerns over a resurgence of the COVID-19 pandemic. David, as always, thanks so much for joining us. Last month, we talked in detail about efforts to open economies around the world and concerns that such efforts might launch a second wave of COVID-19. Can you give our viewers an update on current market values and also on what you're seeing as it pertains to the potential for a resurgence of COVID-19 having an impact on global economies?
Certainly. Let's first take a quick look at the Dow Jones Industrial Average. As we discussed last month, the most recent intraday low for the market was established on the 23rd of March, and only time will tell if this proves to be the low for the COVID-19 event. As of Friday, the 17th of July, the Dow Jones Industrial Average is higher by over 46% from the lows established in March, and year to date, the market remains down by roughly 7.6%. We can clearly see on this graphic how far the market has come in a relatively short period of time. Earlier in the year, markets seemingly priced a much more dire outcome into themselves than what we're actually observing today. As we've come to know more about the disease, and as many companies have worked to produce a vaccine, and as we've made recent strides around the globe to reopen economies, this has caused a retracing of those earlier losses and a repricing of the likelihood of a robust economic recovery.
It certainly appears that markets have recovered quite a bit since the low values of March. What metrics are you monitoring today as you assess the potential for continued economic expansion across the globe?
First, let's take a look at what's been moving the markets lately. On the topic of employment, we learned on the 2nd of July that 4.8 million payrolls were created in the month of June, and the previous report for the month of May had been revised higher to reflect 2.71 million payrolls created for that month. Both of those numbers were historical records for payroll creation in 1 month. Additionally, the 4-week moving jobless claims average continued to decline, and it's now almost 77% lower than it was on the 18th of April. I've suggested for months now that the decline in the 4-week moving jobless claims average was a great sign that suggested stronger employment and economic conditions may be ahead in the coming quarters. And after 2 consecutive records for payroll creation in 1 month, we're certainly beginning to see that. To me, one of the most important aspects of the most recent report from the Labor Department was the news that the labor participation rate had increased to 61.5%. Again, this is a quantifiable metric that reflects the degree by which people who were once temporarily unemployed and receiving benefits have been called back to work. The bond market seems to also sense improving economic conditions ahead, as the TED spread stood at 16 basis points as of the 1st of July. Now, this can be seen as a sentiment proxy for the bond market. On this graphic, we can clearly see how the spread widened as the stock market declined earlier in the year over concerns that COVID-19 would have a much more devastating impact on the economy. As those concerns have been repriced, we can see that the TED spread also has tightened back to historically normal levels. As to what we can glean from around the globe, over the past few months, we've observed the Manufacturing Purchasing Managers Index for many countries. These numbers have also risen considerably. This is important because it is simply a measure of industrial output. You're either making widgets or you're not. And if you are, then workers must be in the factories making those widgets, and by extension, they must be healthy at the same time. As I've tracked PMI values from across the globe, I've also considered them in context with reports of new cases of COVID-19 to discern whether or not we can observe a connection between a return to manufacturing activity and a second wave of the disease. This graphic depicts the manufacturing PMI for China. We now have 150 days worth of data going back to the low reading in February, which looked back into January, and as of today, we still see no new wave of COVID-19 in China. There we have seen values recover from 35.7 to a recent reading of 51.2 and a quick return to expansion territory. Being the epicenter country, COVID-19 hit the Eurozone about 45 days later, and ultimately the United States. So my question is, what can we now glean from the Eurozone in terms of their reporting and any evidence of resurgence? Well, we see similar patterns in the Eurozone. COVID-19 hit the Eurozone about a month later than China, so low points in manufacturing data occurred between March and April. Italy is showing a strong resurgence from a reading of 31 to 47.5 in 2 months. France has jumped from 32 to 52.3, which is in expansion territory in just 2 months. Spain has shown a strong resurgence from a low reading of 31 to a current reading of 49 in 2 months. You can see that these key Eurozone areas listed on the graph have all increased from their low points. Remember that the Eurozone largely began opening in mid-April and about a month ahead of the United States. As of July, we still see no new evidence of any new second wave of COVID-19 developing in the Eurozone. I'm showing you a subset of countries including Germany, Italy, Spain, and the United Kingdom, but all 33 economies of the Eurozone are showing similar bell curves. I think this is solid evidence that yes, it is indeed possible to successfully reopen the economies of the world and do so without triggering a second wave of COVID-19. And frankly, the curve in the United States had been following the same pattern of declination. There is great conjecture over the degree by which the social unrest seen in June contributed to the spike in new U.S. cases. But I believe there is a striking overlay to support that case. Still, the rate of death in the United States continues to decline and very closely resembles the curves that we can observe from around the world. I think that a spike in new deaths would be much more worrisome with regard to a second economic shutdown than a spike in new cases. Bear in mind that we were the last country to be hit by COVID-19. So observing what we can from China and then the Eurozone, I think gives us some very good insight into what we might expect here over the coming 60 to 90 days.
So it seems that the data continues to indicate that it is possible to reopen economies around the world and do so without triggering a new wave of COVID-19.
Yes, that seems to be what we're observing from around the globe. That doesn't mean that the markets won't pause in the middle of the rally that we've had since late March, though, to reprice risk. I am driven by what I can quantify, and at the present time, I'm not inclined to believe that based on the evidence that we have today, that a second wave of COVID-19 induced global economic shutdowns are likely to occur. I remain with the belief that the most likely outcome is that we continue to see a declination in the trend of new deaths and continue to recover economically. I'm also very encouraged by what we're learning about advancements toward a vaccine. And I think that by this time next year, we will have a more positive disposition emotionally and economically about COVID-19. In closing, I've stressed this throughout the crisis, that people need to rise above the noise and remain focused on the long-term objectives that they're trying to accomplish. Continue to dollar cost average through the dislocation and be more concerned with where you will be 10 and 20 years from now, more so than what happens from one day to the next.
David, as always, thanks so much for joining us. For additional information, David may be reached through the means listed upon the following screen. For the Trustful Tribune, I'm Brandon Dawkins.
David Guttery and Brandon Guttery independently offer securities and investment advisory services through Emeritus Investment Company, LLC, member FINRA, SIPC, and Emeritus Advisory Services. Information provided in today's segment is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed and should not be interpreted as tax or legal advice. Any performance stated is past performance and is not indicative of future results.